Hello, I am Gunjan Grover. Today we will be looking into a topic that is essential for every mutual fund investor, but most of them are not fully aware of its details and implications. We will be looking into tax implications on mutual funds. To understand the taxation angle, we need to look into the sources of taxation. Well, there are mainly two sources of taxes in mutual funds, which are transactions and earnings. First, we will talk about the transactional tax. Transactions are taxable only for equity and hybrid equity funds currently. Any purchase or redemption of units for these categories will incur a STT or the Securities Transaction Tax of 0.001%. Earnings tax. The major portion of taxation in mutual fund investments comes from earnings. Earnings from mutual funds can come only from two sources, which are first, periodic dividends distributed by the mutual fund. Second, capital appreciation on the sale of mutual fund units. Let's talk about tax on dividends income first. Previously, dividends in India were subject to Dividend Distribution Tax or DDT, where all dividends were taxed before being distributed to the investor. This was the same for all equity and mutual fund investors. Thus, the final amount received by the investor used to include the tax payment on the dividend. For example, if a company had announced a dividend of Rs 10 and DDT was at 20%, then the final amount received by the investor would be at Rs 8. Currently, there is no DDT applicable for dividends earned of less than Rs 10 lakh a year, and the dividend is directly added to the investor's taxable income and is subject to income tax. DDT of 10% is only applicable for any dividends received more than Rs 10 lakh in a year for any investor. Thus, if the total dividends received in a year for an investor is Rs 1 lakh, the investor receives Rs 1 lakh but has to pay income tax on it. If the dividend received in a year is at Rs 11 lakhs, then the investor receives Rs 10.9 lakhs with Rs 10,000 cut as DDT. But this Rs 10.9 lakh is further subject to income tax for the investor. Now, tax on capital gains. The other source of taxation for mutual funds is capital appreciation. Capital gains are subject to different slabs depending upon the mutual fund type and the holding period of the investment. Capital gains tax is incurred when earning capital gains when exiting an investment. Well, there are mainly two different types of tax treatments depending on the holding period, which are first, short-term capital gains or the STCG tax, and the second is long-term capital gains or the LTCG tax. Short-term and long-term are also defined differently depending upon the mutual fund type. For equity-oriented funds that have at least 65% equity exposure, a holding period of less than 1 year incurs a STCG tax, and a holding period of more than 1 year incurs LTCG tax. For all other types of funds with equity exposure of less than 65%, a holding period of less than 3 years incurs STCG tax, and a holding period of more than 3 years incurs LTCG tax. The tax applicable on STCG and LTCG is also different depending upon the equity exposure. For funds with greater than 65% equity exposure, a holding period of less than 1 year has an STCG of 15% on the capital gains. For the same category of funds, a holding period of greater than 1 year, LTCG of 10% is applicable only on the gains over Rs 1 lakh per financial year. For example, if an investor has seen capital gains of Rs 2.2 lakhs over a holding period of 2 years, the LTCG applicable is 10% of Rs 2.2 minus 2 lakhs or Rs 2,000 only. Capital gains tax on funds with equity exposure less than 65%. For funds with less than 65% equity exposure, STCG is taxed according to the income tax slab for a holding period of up to 3 years, while LTCG is charged at 20% of gains with indexation benefit for a holding period of more than 3 years. Under indexation, the original purchase price is adjusted up for inflation while calculating the capital gains. This is mainly done to prevent excess taxation on gains arising from general economic inflation. Indexation is applicable only for LTCG for funds with less than 65% equity exposure. How are SIPs done at different intervals accounted for by LTCG or STCG? Taxation appears to be tricky due to the timing of the investment, but it is treated as a first in, first out manner. All SIPs are treated as individual investments when calculating the capital gains tax. The individual installments which qualify for STCG depending on the fund type and the holding period are charged STCG, while those installments that qualify for LTCG are charged on their LTCG rate. For example, while redeeming units of an SIP plan in an equity mutual fund, all units which were purchased more than 1 year ago have LTCG applicable to them, while the latest 11 or 12 have a holding period of less than 1 year will have STCG applicable to them. Similarly, on redemption of units purchased through an SIP in a debt fund, all units purchased more than 3 years ago are charged LTCG tax, while all units purchased less than 3 years ago are charged STCG tax. Thus, we come to the end of this video. We hope we have been able to explain and shed some light on this critical topic and helped everyone understand the tax implications involved with the mutual fund investment completely. On that note, here's me, Gunjan Grover, signing off. Bye-bye, take care, keep calm and invest on. We would also like to tell you that Groww has a channel on Telegram where we put the latest updates and news about the stock market, personal finance and much more. So join us on Telegram right now if you want to stay up to date with all the market news and stock updates. We have included the link to our Telegram channel in the description as well.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.